Welcome to Marty's Money. Today, we're talking about passive index investing and how this simple, low-cost strategy can help you work toward financial freedom. Passive index investing allows investors to grow their money by tracking market indexes, essentially groups of stocks that represent part or all of the market, like the S&P 500 or the Nasdaq. By aiming to match rather than beat the market, passive investing takes a straightforward, low-maintenance approach, helping you focus on long-term wealth without the need for constant trading or analysis. While active investing requires regular adjustments, analysis, and often higher fees, passive investing is a set-and-forget strategy that can yield solid returns over time. This approach, when combined with disciplined saving and long-term thinking, can be powerful in reaching financial goals. Basics of passive index investing. Let's break down what passive index investing actually involves. Definition of index funds. Index funds are types of funds, whether exchange-traded funds, ETFs, or mutual funds, that aim to mimic the performance of a specific index. An index fund tracking the S&P 500, for instance, will include all 500 companies in that index in proportion to their size in the market. This means you own a small share of each company, from tech giants to healthcare leaders across various sectors. How index funds work. Index funds automatically track the market, so when you invest in one, you don't need to worry about buying or selling individual stocks. The fund manager ensures the fund remains aligned with the underlying index, and as the market rises, your investment generally rises too. Popular index types. Popular indices include the S&P 500, which represents the 500 largest US companies and is considered a benchmark for the US stock market. The Total Market Index, which covers a broader range of companies beyond large caps, providing exposure to mid and small cap companies, and international indices, which track global companies or those outside the US, such as the FTSE All World or MSCI Emerging Markets Indices. Benefits of diversification. Index funds offer built-in diversification, meaning your investment is spread across multiple companies and sectors. If one company or industry underperforms, it's likely offset by stronger performers, lowering your overall risk compared to owning individual stocks. Benefits of passive index investing. Passive index investing has a few standout advantages that make it appealing for anyone looking to build wealth steadily. Lower costs. Most index funds charge a fraction of the fees that actively managed funds charge. For example, the average expense ratio for an index fund can be around 0.05 to 0.2%, while actively managed funds often charge closer to 1% or more. These cost savings are a big advantage, especially for long-term investors, as high fees can seriously impact growth over time. Market matching. Passive index funds aim to match the market's return, not outperform it. This approach makes it much easier to stay on course without needing to predict or time the market, which studies show most people can't do consistently. Simplicity and time efficiency. Passive investing requires little ongoing effort. By simply investing in a low-cost index fund, you're getting diversified exposure to the market without the need for regular adjustments or intense monitoring. Tax efficiency. Passive funds are also more tax efficient because they buy and hold stocks, resulting in fewer taxable events compared to active funds. This efficiency can be beneficial for taxable accounts, where capital gains taxes can add up quickly with frequent trading. Risks and considerations of passive index investing. While passive investing offers many benefits, it's not without risks or considerations. Market risk. Investing in an index means your returns will mirror the market's ups and downs. In a bear market, for example, your investment may take a hit. But over the long term, markets tend to rise. which has historically benefited passive investors. No market-beating potential. Passive investing limits the potential to outperform the market because the goal is to simply match it. For those hoping to achieve higher returns, passive investing may feel limited, although research suggests most active investors don't consistently beat the market either. Concentration in certain sectors or stocks. Some indices, like the S&P 500, may become overly concentrated in a few high-performing sectors, such as technology. This can expose passive investors to sector-specific risks, even within a diversified index. Inflation risk. Finally, although the stock market has historically outpaced inflation, there are periods when returns may lag behind rising prices, reducing the purchasing power of your investment. This is a potential risk in any market-based investment. Ready to get started with passive index investing? Here are the main steps to set yourself up for success. Step 1. Identify financial goals and timeline. Start by defining your investment goals and timeline. Are you investing for retirement, a major purchase, or to grow your net worth over time? Your timeline helps determine the types of funds and level of risk that might be appropriate. Step 2. Choose a brokerage account. You'll need a brokerage account to buy index funds. Look for a provider with low fees, a range of index fund options, and user-friendly tools. Popular choices include Vanguard, Fidelity, and Schwab, each known for their low-cost index fund offerings. Step 3. Research and choose an index fund. When choosing an index fund, consider the expense ratio. Lower is better, the index it tracks, and the fund's historical performance. Vanguard's VTI, which tracks the total US stock market, or SPY, which tracks the S&P 500, are popular options. Step 4. Begin investing consistently. Consistent contributions can make a significant difference thanks to dollar-cost averaging. By investing regularly, even in smaller amounts, you smooth out market fluctuations and lower the impact of short-term price swings. Step 5. Monitor and adjust as needed. Passive investing doesn't require constant monitoring, but an occasional portfolio review is beneficial. Rebalance if your allocation drifts too far from your target. This keeps your risk profile aligned with your goals without unnecessary trading. Passive investing can be instrumental in achieving financial freedom due to several key benefits. Compounding means your gains generate more gains, building your wealth exponentially over time. For example, investing $10,000 in an index fund with a 7% annual return could grow to over $76,000 in 30 years without additional contributions. Low-cost funds ensure that more of your investment goes toward growth rather than fees. Over decades, this cost advantage can amount to tens of thousands of dollars, providing a significant edge over higher-cost investment options. Setting it and forgetting it. Once set up, passive investing requires minimal ongoing management, making it ideal for busy individuals. It allows you to invest consistently without getting caught up in the volatility or complexity of the markets. Building a balanced, low-risk portfolio for financial security. By investing in broad market indices, you're creating a balanced portfolio that includes companies across sectors, reducing individual stock risk. This approach promotes financial stability and aligns with a long-term wealth-building strategy. Common pitfalls and how to avoid them. Despite the advantages of passive investing, there are common mistakes that investors can make. Chasing high-performance funds. It can be tempting to invest in funds based on recent performance, but index investing relies on a consistent, long-term strategy. Avoid jumping from one fund to another based on short-term results. Ignoring risk tolerance. Passive investors should align their fund selection with their own comfort with risk. Investing in a high volatility fund like the Nasdaq 100 might not be suitable for everyone, especially those nearing retirement. Overlooking rebalancing. Rebalancing is crucial as it ensures your portfolio reflects your desired risk level over time. An unchecked portfolio might drift to riskier assets during a bull market, exposing you to more volatility than you'd planned. Underestimating the market cycle. Stock markets can be volatile. Recognize that while markets trend up over time, there will be down cycles. Knowing this can prevent you from making reactive decisions that may hinder long-term growth. Resources and tools for successful passive investing. For those ready to get started with passive investing, there are plenty of resources available. Recommended platforms include Vanguard, Fidelity, and Schwab. These platforms are well suited for passive investors due to their low-cost index funds and a broad selection of funds. Tools for portfolio tracking and education are essential. Apps like Personal Capital or Morningstar can help you track your investments. Additionally, educational resources like Investopedia and YouTube channels on finance provide insights to strengthen your understanding. Educational resources are key to deepening your knowledge. Books like The Little Book of Common Sense Investing by John Bogle are great reads for those wanting a deeper understanding of passive investing. Passive index investing offers a straightforward, cost-effective path to financial freedom. By following this strategy, you can avoid the high fees, time commitment, and risks of active investing while building wealth steadily over time. Remember to like, subscribe, and join us in our next video for more financial insights to help you reach your financial goals.